From New York City, for our viewers worldwide, I'm Manus Cranny in for Jonathan Farrow. It could be day 7 of a rally on the S&P 500. Interruption by Intel for the Nasdaq. The PCE keeps dreams alive on rates. Countdown to the open begins right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Farrow.
Coming up, the equity rally prevaricates, disappointing Intel earnings. The White House tightening the economy while doubling down on climate. This as investors digest the key inflation figures ahead of the Fed. We begin with a big issue. Buckle up. We're in for a bumpy week ahead.
The Federal Reserve.
Its payrolls. Big Max 7 tech earnings next week.
Tech earnings are supposed to be up in double digits.
From a profitability perspective, tech is likely going to be the sector that can deliver.
I think we're going to hear Powell more in this careful camp.
Officials will more clearly outline how they're thinking about rate cuts over the next year.
Is this a Fed that's looking to cut rates as early as March, or is this a Fed that's waiting to kind of take their time?
They'll move to a more kind of balanced language.
They're going to be taking a read on that macro outlook to figure out when to cut rates.
We're looking at the data, and the data looks strong.
One of the key pillars to economic activity remains the labor market.
The labor market has been rebalancing in the U.S.
Under the surface, the labor market is cooling.
Look at how much non-farm payrolls have come down from 6 months ago, from a year ago.
There's improving prospects for a soft landing.
There is a path to a soft landing.
Joining me now, it is Nadia Lavelle of UBS, Morgan Stanley's Vishy Triputer join me. So here we are. The rates market has just had a fill signal from PCE. The equity market needs a fill or kill signal from tech earnings next week. As you look at the momentum in this market, record high 6 day in a row, credit spreads are narrowing. Are you all in on risk from here? Vishy, let me take it to you first of all.
I think there is a lot. I think a lot depends really on how the next week's data on both tech earnings and the employment data show what they signify. We are clearly firmly in the camp of a soft landing, and we have been for some time now, maybe early 2023. So we continue to reinforce the notion that we are in a soft landing territory. But the challenge for the markets is much of the soft landing is already in price.
Yeah.
So given what's going on, given what's already in price, we would be threading the needle very carefully here.
Okay. Nadia, good morning. Good to see you. Is tech earnings the fill or kill for adding risk for you on the equity side?
It's important. I mean, of course, next week will be an important week because we have 40% of the S&P market cap reported. And of course, we have a bunch of macro data. So the macro and the micro data could cause some choppiness as the market really absorbs that. But we think that, pullbacks are going to be boring, and pullbacks are quite healthy for a bull market. We do expect tech to be able to deliver on the earnings next week. Some of our early checks are already pointing to that. So we think that this market can continue to be a grind high. Now, in fairness, Manus, the market is not too far from our base case scenario for 5,000 on the S&P 500. But when we look across our scenario, and I glaze over at that Goldilocks scenario, we're starting to lightly, at least half check some of those boxes, especially if the surprisingly strong economic momentum that we saw at the end of the year can continue in the first half of the year. And of course, the inflation numbers continue to surprise to the downside as they did this morning. You could see this market grind higher for the rest of the year. But we need to get through the earnings season to sort of determine the slope of that angle for that grind higher.
Yeah, and it was a jolt from, Intel, wasn't it, overnight as well. I think the best line I've heard recently has been, I've never met a wealthy pessimist. That was an asset manager who chatted to me recently when I said, I'm a bit doubtful about all of this. And he just said, I've never met a wealthy pessimist. Let's talk a little bit more about the numbers, the key inflation data ahead of next week's Fed decision. We are equipped. Mike McKee has gone under the hood. Mike, what we got?
Well, what we got is good news, at least for those in the equity and bond markets who are worried about what the Fed might do. It certainly takes any rate increases off the table to see inflation in the PCE index core drop to a 2 handle for the first time since before the pandemic. We get 2.9%. And the question is, does that continue? If so, it'll raise a lot of further questions about what the Fed does, and we'll get to that in a second. Personal income up 0.3%, and personal spending a very high 0.7, very strong is what I wanted to say, 0.7%. So Americans are still spending, incomes are still rising, and inflation is going down. That sets us up for what the Fed does, and of course we'll see their decision on Wednesday. Jay Powell, at his last news conference, suggested they're not waiting until they get to 2%. They'll start before that. The reason you wouldn't want to wait is policy would be too late. You'd want to be reducing restriction on the economy well before 2%, because if you get to 2%, you could overshoot, is basically what he's saying. So now that we're at 2.9 at least, and in the 2% range for both of the PCE indicators, is the Fed going to cut sooner? Well, the market doesn't think so. We've seen a reversal in the March rate cut odds, now down to the lowest that we've seen this week. Why might that be? Well, you look at the spending numbers and the savings rate, this personal income number, adjusted for inflation, only 0.1%, and the savings rate went down to 3.7%. So maybe there's an argument that Americans are going to peter out on their spending, but more likely it's the data next week. You guys were talking about how much we get, and of course we get consumer confidence on Tuesday, but it's Wednesday that's the big day because that's the Fed meeting, but also the employment cost index tell us more about wages and salaries and refunding. What I'm told is that's going to be maybe the biggest indicator of the week. Friday is jobs, but refunding is going to really matter to the debt markets. They want to see what kind of demand there is going to be and what interest rates are going to be, and that will affect everybody going forward in terms of where they think the rates are going to be. Thursday, Friday, as I mentioned, busy days with ISM productivity claims and January jobs. And so we'll keep ourselves quite busy next week.
Yeah, it is going to be sort of a filler kill moment for both rates and equities. Mike, thank you very much. Let's see. It's going to be a busy week. Nadia Lovell and Vishy Tiruptar are with me as my guests. Nadia, I want to go to you. It's interesting. I was chatting to one of the people on IB this morning. This is what he says to me. We've taken a full cut from the Fed out of the market since January. Yet risk assets, they just don't care a bit. When you look at the flow into American equities and into tech, that is true. Is there any sense of exhaustion?
You know, I think, as we know, the equity markets is pretty much forward-looking, and so it's the expectations that you will see rate cuts this year that's more important. We're looking for 100 basis points of cut this year, starting around May, and so we think that that will be positive for the market. Now, we think that the flows are still going to be strong into the equity markets. When you think about how much money is sitting on the sideline, particularly in money market funds, as the Fed starts to lower rates, those assets are likely going to be searching for better returns elsewhere, whether that be in the fixed income market and in the equity market. So that could provide a tailwind as we get into the back half of the year, as long as the economic data continue to support equities, which we think that it will.
Okay, I mean, it's a question of which home do you go to? Do you go to a little bit of bonds and IG, or whether you take the equity on board, Nadia, isn't it? Let's take that across to Vishy. When you look at credit spreads at the tightest in 2 years, again, I'm keen to get a comprehension of the scale of flow into credit. This is how I know it's a contrarian indicator. I'm even talking to somebody about the BlackRock IG funds myself. That's how low it has got that I'm actually interested in diversifying. That's a contrarian signal if I ever had one.
I think that's a good point. I think Nadia makes a really important point. This reallocation of money that's currently sitting, that has been sitting in the money market funds, is going to be a major story this year. We think that the better opportunity, certainly for the institutional component of the money market fund that is sitting there. So, in 2023, about $1 trillion got added moved into money market funds. We think about 40% of that from institutional. We think that will find its way towards fixed income, particularly high quality fixed income. Even though aggregate spreads, as you point out, are tight, if you look at the components of the credit curve, the 1 through 5 year part is actually not as tight as, say, the longer end of the credit curve. So we expect to see more money flowing into the 1 through 5 year part of the high quality investment grade credit.
Just to square it away, a 1-2 punch from each of you. The PCE comes in at 2.9%. That is the preferred measure of the Fed. What is the risk of a March cut? Nadia?
You know, we cannot rule out a March cut. I think the market pricing in a 50-50 chance seems reasonable. Of course, we'll be paying close attention, as Mike McKee noted earlier. The ECI is important because the Fed has been highlighting that wage growth still remains too strong, and we want to see wage growth come down closer to 3.5%. So that will be key. But at this moment, we'll see what the Fed chair says next week. We wouldn't be surprised, and we know that the Fed has been reluctant to wave the victory flag, but maybe they'll start to raise it and let it blow a little bit in the tailwinds of the economy.
20 seconds, Vishy. Filler, you know, is it live? Is it really live? Is March really live? Would they dare?
We still think June is a more likely outcome and perhaps a greater risk of a May. There are some significant revisions to both employment data and to the inflation data coming up on February 9th. And also, then I think the near-term data, the 3-month annualized, 6-month annualized numbers may show some uptick in the first quarter. All of that puts us in the camp of June. Obviously, we'll be watching data. If data surprise and to the upside, if data changes, we will change our mind.
Okay, we change when the data changes. Nadia Lovell and Vishy. Tripper, stay with me, more work to do. Let's go under the hood, see what's moving. We've had some big moves from Intel. Abby, what have we got? Build the story.
We do indeed have some very big moves. It's interesting because the U.S. futures are very flat. But beneath the surface, to your point, let's start off with the shares of American Express. They're moving to the upside, up 1.5%. They missed in a small way for the quarter that was reported, but the 2020 forecast well above estimates, the range above the street profit estimate of $12.40 per share. Restaurants highlighted as a bright spot. You were just mentioning Intel, though. Look at that stock in the pre-market down 10%. It was a big beat for the quarter that was, but the first quarter coming in very short on both sales and profits. To give you an idea, 13 cents versus the estimate of 34 cents. So the turnaround maybe not sticking there. That could be the fear. Western Digital down 3.1%. They beat, but after a nearly 40% rally over the last 12 months, investors wanted more. And then we've had some breaking news in the last few minutes, Manus. If we take a look at the shares of JetBlue and Spirit Airlines, JetBlue popping, Spirit plunging. This after JetBlue warns that the Spirit deal may be terminable on or after January 28th. They informed Spirit Airlines that certain conditions to closing required by its merger agreement may not be satisfied on time, suggesting they do not want to go ahead with the appeal. We'll be, of course, waiting for more information on that story.
Yep, and also there's a whole host of debt rollovers to consider in that story. Abby, thank you very much. Coming up on the show, the White House taking a victory lap?
We have seen some turnaround in sentiment in recent months. So I think Americans do believe inflation's under control.
From inflation to energy, the Biden administration tightening the U.S. economy and freezing approvals for LNG exports. Why now? That conversation up next.
We have seen some turnaround in sentiment in recent months. The University of Michigan Consumer Sentiment Index has moved up quite a lot. Inflation is now near term at close to the lowest levels we've seen in that survey. So I think Americans do believe inflation's under control.
Secretary Yellen there tightening the U.S. economy. This is the White House hits the pause button on approving new natural gas exports. President Biden writing in a statement, this is what we had from him. We'll take a hard look at the impacts of LNG exports on energy costs, America's energy security, and our environment. Now, this pause on new LNG approvals sees the climate crisis for what it is, the existential threat of our time. Interesting time to make this decision. Katie Lyons is in D.C., Will Kennedy is in London. Kayleigh, good day to you. This is a very interesting political moment to make a call like this. Bold and differentiating. Your take?
Yeah, Manus, it's interesting that this move is happening in an election year, and this is really the launch of a process that could take months, lead us up potentially to that election in November that is now just over 9.5 months away. Essentially, what the Energy Department is doing here is reanalyzing energy, climate impact, economic impact, national security impact of these exports, because the current assumptions that they are using in this approval process haven't been updated since 2018. And officials say that there is evolving information on how exactly methane burning is impacting global warming, essentially. So that is what they're reanalyzing here. This is a process they are not putting a firm timeline on, but they have indicated it could take months. They're going to do it expeditiously. It's not going to affect current levels of LNG exports. It's not going to disrupt projects that have already gotten approval, but it could potentially delay approval for other projects that are out there. The real political calculation here for the president is a difficult one. On the one hand, there is pressure from the left, from environmentalists, to consider climate change more heavily, and the concern being that if you are putting infrastructure, long-term projects together for exporting LNG, that means you're going to be weaning off of it way later. This is something that's going to be taking place for generations to come, potentially. Then there's the pressure on the right to not put climate ahead of American jobs and the overall U.S. economy. So it's a very difficult calculation here. Clearly, though, this is something the administration is moving forward with. There's also the question about what ramifications it may have geopolitically, as the U.S. has made a commitment to help Europe essentially not be dependent on Russian gas in particular because of Russia's invasion of Ukraine. And there's a question as to how much this could disrupt those efforts, Manus.
Yep. Katie, thank you very much. As you say, those promises to Europe have massive political reverberations. Mr. Kennedy, how are you doing? Not only have you got OPEC to contend with, this must be music to the ears of the Qataris. I mean, they're side by side. They are with the U.S. in terms of the #1 exporter. So if the U.S. steps back, it's hello market share for the Qataris.
That's exactly right, because the Qataris are going full steam ahead to increase their export capacity by about 60% over the next few years, and they're looking to sell that gas around the world, including to Europe. I do think the decision, as Kayleigh said, will be a major concern in Europe. Europe has successfully stopped importing Russian pipeline gas, but it's only been able to do that because of the flow of US LNG. And if those exports are capped at a lower level than people were expecting, that means that gas is going to be more expensive than it may well have been, and that will be good for Qatar, but another blow to the European economy, which is struggling to compete with other parts of the world on energy costs.
Okay, well, it's certainly going to have massive ramifications at the energy complex, the price of the gas at the pump here as we go towards the elections. Geopolitics, I don't think necessarily is a vote winner in this country. It's all about what's in your pocketbook. Katie Lyons, Will Kennedy, thank you very much. The energy complex discussed there, Nadia Lovell and Vishy Tour with me this morning. I mean, translating those high-level policy moves at this stage is very much about how it'll play out perhaps in the head-to-head with Trump. But I want to get a perspective from you, Nadia. First of all, we have this pressure on oil prices and pressure on OPEC Plus perhaps to extend their cuts. Your view on the energy market as it stands right now?
Yeah, we have a modestly positive outlook on energy equities and all at the moment. Of course, it's been a volatile time, and the conversation is shifted towards supply for this year and whether there will be an oversupply market. We don't think so. We still expect a slight deficit in the market for the first quarter. We think that OPEC Plus will extend those production cuts into the second quarter, and that should help support prices. And so we're looking for a Brent price to get back to about $85 this year. And that should also help support the equities. But again, it's going to remain volatile and things are fluid, and a lot of it is going to depend on how the rest of the winter season progresses. We're already seeing some supply disruption from the U.S. side. But so far into January, it looks like OPEC Plus exports have been coming in lower than in December. And so that's flowing through.
And Vishy, from your perspective, from the fixed income perspective, the dissipation in oil prices in the back part of the quarter, to a certain extent, helped. I'm not saying it was the only reason, but helped with inflation expectations settling a little bit better. There is a risk here. We're ticking up. 76.81 is where we are on WTI. There is geopolitical risk in this market. So to what extent can oil be an interrupter in the break-even or the inflation outlook?
We think not a tremendous amount. We think it's our expectation, and oil is outside of my direct realm of expertise. My colleague Martin Ratz's expectation, who is our commodity strategist, has a mid-80s price book for Brent over the course of the year, and a relatively range-bound expectation there. And what I think is really our market, the fixed income market, is going to be more focused on is really what the services component, perhaps core services ex housing, the core PC, core service ex housing. In all of those calculations, at least directly, oil prices are not going to be that material. And in this range, as long as we're in this range, it's not going to be that material. I think that's what the market is most focused on, and looking at the potential upside. The road to the inflation going down is not going to be a linear, straightforward road. It's going to be a bumpy road. And the source of that bumpiness, we think, comes not so much from energy, probably more likely to come from core services ex housing.
Yeah, I mean, the services is where we are seeing that stickiness prevail. Thank you to both of you. That is Nadia Lovell and Vishy Tirupta joining me this morning on the markets. Coming up, your morning calls. A little bit later on, we've got Max Kettner, see whether he still has his clarion reverse Goldilocks call. Why investors need to prepare. That conversation with Max in just a moment. Records interrupted. In the space of 30 minutes, we just sweep into the red on the S&P 500. Intel is just breaking the will to live on the Nasdaq, down 0.5%. Intel down 11%. Let's get you up to speed with your morning calls. Will it change your mind? What the analysts say. First up, TD Cowen upgrading American Airlines to outperform, expecting the shares to benefit from upcoming Investor Day. Next up, Deutsche Bank upgrades Snap to a buy, pointing to a strengthening in the outlook for the airline. Advertising. Finally, Oppenheimer upgrading Coinbase to outperform, listing a handful of catalysts that are on the horizon. Brace, brace, brace. I'll take you on a bumpy ride to Goldilocks land. Max Kettner has a warning for you and the investors out there. Don't chase the equity rally. That conversation with Max next. Equity markets reflecting on services inflation, which is a little bit sticky. It's Friday, the day that records come to die. We've had 6 days in a row of rally. In the past 30 minutes, we're giving it back, down 1/10% on the S&P 500. Intel is a car crash on the guidance. Gensler's got to do an awful lot to guide this market. You've got euro dollar pipping up by 1/8% at 108.64. Did you really think Lagarde meant that she was going to go earlier than the summer yesterday? Oh, look, they got ticker tape at the Nasdaq today. That is very cool. Bright spring. They're a happy crew at the Nasdaq today. We're up on yields, up by a pip. The headline PCE comes in sub 3%, but it is the services part, which is the highest monthly change in 3 months. You'd hardly call it exorbitant, ticking up on the 10 years. And crude is down by 0.5%. 76.98 is where we trade at the moment. One stock that I mentioned, it is Intel, and the chip maker is sinking. You've got disappointing forecasts, to say the least, renewing uncertainty around this stock. Abigail Doolittle has the detail. Abby.
Well, Manus, we have this stock plunging worst day since October of 2021, and it's one reason that we have both the S&P 500 and the Nasdaq snapping a 6-day winning streak, because it is the biggest weight dragging on both of those indexes. So they actually put up a good quarter, but to what you just said, the outlook, especially for the first quarter, very disappointing. They're talking about $12.2 billion to $13.2 billion in revenue versus the estimate of $14.25 billion. So a pretty significant miss there. Profits, 13 39 cents versus 34 cents. So more than a 50% haircut there relative to expectations. Now, the chip maker's personal computer business is recovering, but demand in the lucrative market for data center chips is not so strong. In addition, they are contending with a slowdown in programmable chips and components for self-driving vehicles. They've also talked about getting into the foundry business. That seems to be stalling. There's not a lot of information there. All of this puts that turnaround that you were talking about, a fledgling turnaround, into question. We have at least one downgrade on the stock to a hold from a buy over at, I believe it is Raymond James. I'm just trying to pull that up right now. Needham, actually. And the stock up more than 60% into today over the last year. They needed to put up more. They could not miss the outlook like this. And we have the stock, again, plunging on the day.
Yeah, and you've got their original customers designing their own chips, so it's a tough world out there. Abby, thank you very much. Let's stick with the earnings theme. Visa's robust results, they're being overshadowed by January's weak trends, but a more optimistic response to Amex. Simone Foxman has the details. Simone.
Yeah, Manus, the investors, at least this morning in early trading, seem to be more focused on the outlook than they are on the latest quarter results. We got news from both of these companies today. Visa actually performing a little bit better than expected in its last quarter, but some of these results and some of the trends that I was seeing in January may be related to some negative weather, kind of overshadowing the picture for the year. So it saw quarterly profit up 8% year on year. That was ahead of expectations. Revenue up 9%. But the CFO is saying that this was a short-term blip in January. However, Jeffrey's saying, steep acceleration for the year, low double-digit growth. We're going to need to see the company really come back from that after a slow start. Amex, however, missing estimates, but seeing a stronger outlook than anticipated, boosting its quarterly dividend as well. So maybe we're seeing some of the response there. From a macro perspective, though, both companies saying they see a very strong consumer. They're projecting that throughout the year with double-digit revenue growth. Also should be noted, Visa hit an all-time high yesterday. So maybe some of the response is people just taking profits here, Manus.
Yeah, there's always that. Plus, I've yet to get an Amex card as well. I've still got my Visa. Simone, thank you very much. Simone Foxman there. Let's turn to transportation. Norfolk Southern is missing their estimates for the fourth quarter, marking an end of what the CEO calls a challenging, transformational year. Isabel Lee is with me. Do the investors believe that? Not really at the moment.
Not really at the moment. Shares are lower, around 3%, Manus. It wasn't a good cycle for Norfolk Southern. The railroad operator reported a drop in operating income, and that's dragged by another $150 million last year that resulted from the derailment of their trains in Ohio. And the company also reported an adjusted EPS that was lower than estimates. They reported $2.83. That's slightly lower than the $2.87. Its railroad operating revenue also fell around 5%, as well as the merchandise revenue, which is around 1% lower. For the year, the company is targeting a revenue growth of about 3%. So maybe that's where the transformational part enters. On Thursday, we have some bad news. The company announced it's laying off 7% of its non-union workforce, and that's amid just a tough freight cycle. By some calculations, this would translate to around 330 people in their workforce. For now, Norfolk shares are down 3% in the past 12 months. It's also lower by 1%, Manus.
Isabel, thank you very much keeping a track of the earnings there. Excuse the pun. Let's turn to telecoms. T-Mobile's earnings missing the estimates. Despite strong gain in subscribers, Katie Greifeld has been tracking the mobile. Katie.
It's pretty much a mixed morning, I would say, for T-Mobile. You take a look at the shares right now, currently a little bit under pressure. You had fourth quarter EPS. It missed estimates. It came in at $1.67 in the quarter. Analysts had been looking for $1.91 there, so a bit light. And that's really overshadowing that good news that you mentioned on the subscriber front. T-Mobile, it actually added 934,000 phone subscribers in the quarter. That is well ahead of estimates. Analysts were expecting 886,000, and it also outpaces peers AT&T and Verizon, which also reported gains when it came to subscribers. Well, analysts are praising the growth and the quarter overall. They seem pretty rosy about this report overall. They did note that share buybacks did not meet expectations. You also had churn a little bit higher than expected. But to get into some of the commentary, you had Citi writing that while there were some, quote, bright spots and some wrinkles in this report, more good than bad, you also had Morgan Morgan Stanley's Simon Flannery, noting the less than robust expected buybacks as mentioned, but he also wrote that he continues to see T-Mobile as leading the industry with significant share gain potential to come in the smaller markets. Maybe that's helping the stock rebound a little bit right now, currently down about 1%. We had been closer to about 2% lower pre-market, Manus.
Okay, Katie, thank you very much. HSBC's Max Kettner listening in to the roll call of results and the macro flow. But he delivers this warning with this. While it may be tempting to chase the latest all-time highs, we maintain our view of reverse Goldilocks. If anything, 2023 has taught us not to chase, but to fade the trends. Max Kettner has never been one for the crowds, but I will challenge you. Good morning. How are you? Good to see you. So look.
Good morning, Manus.
Record after record on the equities. Credit spreads are on the tide. Strong U.S. growth. China stimulus. Tell me where the cracks are.
Yeah, look, I think the cracks are perhaps that inflation is a bit stickier than we thought, right? In fact, when we look year to date at the risk asset rally, it is not similar to what we had last year. Last year, right, it was almost enough that we had this tech-driven rally in U.S. equities and U.S. large caps. And that was sort of propelling everything higher, from emerging market debt to high yield credit or high beta effects. When we look at those asset classes since the start of the year, well, the reality is when we look at emerging market debt spreads, they're up 20 basis points. High yield spreads are up 10, 15 basis points in the US. When we look at things like EM local currency debt, that's down 2.5%. The Russell is down 2.5%. So it's really just those handful of stocks that are driving the gains. But under the hood, we are starting to see some of those cracks. And I would say it's perhaps that we're getting a little bit too comfortable with inflation completely disappearing. And on the other hand, we see that in the pricing, right? We see that, for example, short-dated inflation expectations in the US, they came down from sort of 2.70 down to 2% in the last 2.5, 3 months. We saw that when we look at, for example, global equity performance, compare that with earnings revisions. I would argue, look, even if the reporting season now is good, and even if what you guys were discussing just now, even if the guidance of most companies turns around and is actually much, much better from now on, most of that is now in the price, right? Most of that, even if earnings revisions do pick up, that is now priced in. The same thing goes for valuations. We know that PEs have gone up, but that was mostly really a function of lower yields and lower rates volatility, but that's been largely played out now. So I do question, what is the catalyst up from here?
Okay, you question the catalyst up, which then makes me cautious about what I have in my exposure. My question is, do I de-risk from equity and take, you talked about the sort of the pop, slightly pop, I wouldn't call it a hectic move, Max, on high yield, but do I de-risk in equity and high yield and go for IG over high yield until there's better clarity?
Yeah, I think so. I think that's probably the right strategy. So you want to sort of hide out in short duration stuff, right? Short duration IG credit, particularly in the US, because bear in mind, the environment that we foresee, which we're sort of calling reverse Goldilocks, or call it bad news becoming good news, those sorts of backdrops, they typically argue for a stronger dollar, right? So if you're hiding out in shorter duration credit, for example, in US dollars, that tends to work quite well as a hedge. We do still think that energy prices can trend higher from here, right? So we're not bearish on all the risk assets per se. In fact, our view is not a classic risk off. It's the exact opposite.
And you and I spoke about this before. So maybe the slightly more challenging question to frame to you is this: how long do you think? How enduring will reverse Goldilocks be, Max? Do you think it's going to be a period of time, Manus, until I see rate cuts, stabilization, syncopated drop in inflation? Does reverse Goldilocks is it a front-loaded 2024 scenario plan?
Yeah, I think that's true. It's not going to be a view that will pan out throughout the entire 2024, right? Look at the last year, for example. You were just reading some of the stuff that we put out in a note this week. The fact is, when we look, for example, 12 months ago, people were playing US recession for a month or two. And then for 2 months, we played banking crisis and credit crunch. And then for 2 months, we played, debt ceiling and Treasury general account. Then we played Goldilocks for 2 months. Then we played higher for longer. Yields can never go down anymore, right? We played that for 3 months. And now we played for 2-3 months, we played the whole Goldilocks theme. And, just going through that from the last 12 months, it really taught us, look, probably this is not the environment anymore like it was in the 2010s where you want to chase those trends, but where you want to say, look, the next one is going to be perhaps exactly the opposite. And that's not going to take 6, 9, or even 12 months. It could easily be coming, snapping back very, very quickly, perhaps even next week, right? With some of the, perhaps there'll be some more disappointing news from the tech sector because the expectations are so high. Maybe the Fed does put some wording in around the easing of financial conditions that makes them a little bit uncomfortable, right? What about the quarterly refunding announcement on Monday, for example? What about non-farm payrolls, wage growth, right? Wage growth also on the employment cost index. So there's quite a few things that under the hood, I think, could be questioning that super dovish pricing now and the exuberant pricing in equities with regard to valuations and earnings.
Okay, so I hear you. I've got the lines from the report. Hide out in a bit of cash, short-dated credit, and you like Japan equities and energy. So that is what you like. What is it that would cause you to rewrite the top line on the research note, which goes, prepare for reverse Goldilocks? What is it that backs that up? What is it that makes you rip that off and go, okay, I'm turning?
Yeah, I think one of the things that we really need to look at is sentiment and positioning. When we look, for example, at our sentiment and positioning indicators, yes, they have gone down. You've seen that also in survey-based sentiment. So you've clearly seen, I think, since the start of the year, talking also to our clients around the world, I think most clients on the discretionary side are sort of neutral, really trying to figure out what's going on. Is that rally going to broaden out? Is it going to broaden out into other asset classes, into the broader sectors within equities as well? Whereas on the systematic side, when we look at positioning of CTAs, of risk parity funds, of volatility target strategies, the reality is on our measures, that is almost maxed out long. So frankly, all I need right now is I need a bit of a turn in shorter term momentum. And once that turn in momentum comes, then, those strategies, those systematic strategies really will turn very quickly from net buyers and buying pretty heavily to actually pretty heavy net selling, right? And that can go very, very quickly. And that really would be, for us, one of the triggers really on that reverse Goldilocks coming pretty quickly.
And then can I just take you to the other side of the barbell? What would be your greyest swan?
Yeah, I think especially for a view like ours, right? I guess the biggest risk is that the next couple of weeks, next couple of months, we're going to continue to see data like we had last week, right? Or even yesterday, when, GDP rises more than expected. You look at the number and your first reaction is, oh God, like, can't we see really 6 rate cuts this year with such a strong growth number? And then at second glance, you look at the inflation side and you're saying, it's great, right? We're back to target on some measures even below that. So if that continues, if in the next couple of months, we're going to continue to see, better than expected growth, but inflation basically gradually going towards target without any kind of disruption, that I think it's basically Goldilocks on pretty much, the next couple of months. And it still then argues for tech and for AI and a continued rally across everything.
So before I let you go, what's the style of jacket? This is the full kind of very beautiful German tailoring, is it? What's the name on that?
It is underlying my Bavarian nature, that.
Bavarian nature. You just see Max somewhere near to you with a... What's the name of the thing you drink out of a stein, is it?
Yeah. Oh, yeah. That is called beer, Manus. That is called beer.
Okay, this is going to descend. I'll see you soon. I'll see you in America for a beer soon. Max Kettner there with his reverse Goldilocks, but he's open to change. Coming up, wrapping up the big week of earnings.
LVMH is remarkable in that its fashion and leather goods segment added in incremental sales the entire top line of Tod's, Ferragamo, and Burberry put together. That's just how much it grew on top of a very big base already.
The monster that is Louis Vuitton. Earnings season heating up. Next week, big tech on the deck. That conversation next on Bloomberg.
If we look at kind of scale, LVMH is remarkable in that its fashion and leather goods segment added In incremental sales, the entire top line of Tod's, Ferragamo, and Burberry put together. That's just how much it grew on top of a very big base already. So that is what has insulated its operational leverage relative to its peers. And I think that's also important in that many companies in the sector delivered outsized margin expansion in the wake of the pandemic.
That is a heck of a moat around one brand name in the luxury sector, showing signs of resilience. It is LVMH delivering better than expected results. Shoppers treating themselves to the brand's luxury handbags and clothes. Organic growth was monumental there. Simone Foxman is with us. So much for the aspirational shopper. They're not interested in them right now.
Yeah, it seems that the luxury shopper is carrying the day, and shares up the most since 2009 on the back of these results. Really reassurance for the street in the wake of some of these concerns about weakness in the high-end goods industry overall. Note that LVMH had hit a 14-month low yesterday, but fashion and leather, 9% organic growth in the fourth quarter. Wine and spirits expected to sink 7%, but then seeing an unexpected 4% surprise after 2 quarters of declines, especially on the back of that slowdown in the United States. So overall organic revenue growth up 10% year on year. The estimate had been for 8%. Management also hitting a very robust tone. A lot of analysts across the street noting that, confident in their 2024 despite some of the geopolitical and macroeconomic headwinds. The CFO also said, though, that they don't plan further price increases in 2024. Citi says this tone indicative of the idea that 2024 could be a smooth normalization rather than the difficult one that many had been anticipating. Able to weather those winds of U.S. slowdown, able to weather those winds of Chinese consumer, and that's why we're seeing that positive bump in shares today, Manus.
Yeah, you call that normalization with swag. Simone Foxman there on Louis Vuitton numbers. From retailers to big tech, we get the results from 5 members of the Magnificent Seven next week. The preview, Katie Greifeld has the curtain raiser. Katie.
Manus, buckle up because we have a big week next week. In the coming 7 days, you have 108 companies in the S&P 500 taking the stage. That amounts to $16.8 trillion in market cap, making it the busiest week of earnings season. So let's name some names here, because on Tuesday you have Alphabet, you have Microsoft reporting, then you have Apple and Amazon on Thursday, as you can see on that calendar, and then Meta closes us out on Friday. And like you said, 5 of the Magnificent Seven just there alone. And traders will be watching to see if that group can overcome the ills of Tesla. The EV maker really whiffed on earnings this week. That's adding to a 25% loss already in 2024 for Tesla. And the Magnificent Seven as a whole, it's managed to actually hold up despite Tesla's performance. But obviously, the next few days are crucial to determining whether or not that dynamic is sustainable in the long haul. And don't forget, in addition to big tech earnings, we also have a Fed decision and a jobs report. So it's going to be a lot of fun, Manus.
Yeah, a heck of a lot of fun. Katie, thank you very much. Looking ahead to next week. For some of the sector price action, let's get back to Abigail Doolittle. Bit of a guess here. Maybe tech might be under pressure.
You're right about that. That, of course, is the worst sector on the day. On Intel having its worst day in more than 2 years. As a result, we have the S&P 500 actually looking at a small decline right now. The first time we've seen that in 7 days. To the upside, though, is consumer discretionary up 0.5%. Whirlpool, Tupperware, along with Tesla, all helping out there. As for the week, let's take a look at the best 2. And it's a little bit of a surprise here, actually, to me. Energy is the best sector on the week, followed by communication services. And then to the downside, we're looking at consumer discretionary. I think that has a lot to do with Tesla's fall yesterday. And then healthcare, a small decline. But on the week, Manus, we are looking at a 1% gain right now, at least, for the S&P 500.
Okay, keeping the dream alive maybe for the week. Abigail, thank you very much. Coming up, the market-moving events that will dominate your diary. That's next. Record run up on these stocks is interrupted. Do you really want to take that much risk going into next week when you've got the Mag 5 reporting and nearly over $60 trillion worth of market cap hitting the tape next week? Do you want that risk on your book? Well, let me tell you what you do need to know to focus for the week. Tuesday, it is Tech Mountain. Earnings come in from Alphabet and Microsoft. Wednesday, you have the Fed's decision and Chairman Powell's news conference, guidance on the inflation and rates. The Bank of England, it's their turn on Thursday. And then more and more tech, Amazon and Apple and Meta earnings pile in. Finally, the crescendo of the week, the payrolls report with wages, jobs, and all you need to know about the health of the U.S. economy. It's Friday. We got there. Nothing quite broke. Perhaps interrupted on this equity rally for now. Countdown to the open. Friday, that's it from me. This is Bloomberg.